Hey, it's Nathan with OptionsForAll.com. In this video, I'm doing another backtest case study, and in this one, trying to find the best settings for the put credit spread on SPY. Now, we're going to have a few different parts to this video. The first part, we're focused on optimizing the deltas and the widths between the strike prices. And then as we progress through the video, we will look for different optimizations that we can make. So maybe we will mess with some VIX filters or SMA filters, exit conditions. We'll look into rolling and see if we can improve our results. So real quick, I want to go through the settings for the back test. So like I said, we're doing SPY. We're doing a 10-year period from January 1st, 2016 through December 31st, 2025. Starting capital, we are using a peak margin with a 1.5x multiplier, or buffer I should say. And so basically what that means is we are going to be using the optimal amount of capital based off of the most amount of capital that we'll have deployed plus a 1.5x buffer. So like a 50% buffer on that amount. And hopefully you're understanding what I'm saying. If not, you'll see it as we go through the examples. We don't have any commissions on the legs and our fill price is at the midpoint. Like I said already, we're doing the bull put credit spread. So that's what we're focused on. And at this point in the video, we are focused on optimizing for the deltas. So I went from 0.5 or -5, -10, -15, 20, 25, 30, 35 deltas. And then for offset, I went from $5. So we're doing a dollar offset. So -$5, -10, 15, 20, 25, 30, 35. So a wide range of deltas and offsets between our strike prices is what we're testing at first here to see what gives us the best results. I am trading on specific trading days because I'm doing it for what I might actually do, and that would be trading on Mondays. And if the market's closed on that Monday, we will just do it on the next trading day, so that Tuesday or Wednesday or whenever the market opens. And we're not doing any filters on this particular part of the case study, and no exit conditions. We're going to see what we get with what we got so far, and then nothing for roll management. So I ran a bunch of back tests, and let's go to the history real quick. And so I ran 49 back tests with all those settings, so you can see all the results right here. But what I want to do is switch over to the graph view because I think that helps us better visualize the data. And so here's all of the back tests, and we can see them all nice little dots right here on our scatter plot. And we have different views we can use to help us analyze the back tests. So I'm just going to go through the views basically and select the best case study or the best back test for those particular results. So we'll start with the risk adjusted returns, which is CAGR versus max drawdown. And what we're looking for is the lower right quadrant, which means it has a high CAGR and a low drawdown. So we got this one, which is definitely the furthest one out right. So we'll go select that one, and it said lower right quadrant. So we'll just go ahead and select this one as well, since it's like the lowest rightest one that we got. So we got two right there, and there's another one right behind it. Maybe I'll go ahead and select that one as well. So we got three selected. All right, so moving on, we got capital efficiency. So this is return on margin versus max drawdown. And we're looking for the lower right quadrant, high returns, low drawdown. And basically those are the three that we selected right there. This one's a little bit better than this one, so maybe I'll just unselect that one, trying to limit our options here. We don't want to optimize, every single thing, or we'd be here for forever. Moving on, we got consistency versus profitability. And right here, we're comparing win rate to total P&L. Now, I'm going to ignore this one because basically we have high win rates on the low deltas. So you see a -5 delta right there, and that's what all these case studies are, just really low deltas. And then we see our -10 deltas. And that's because, of course, the lower the delta or the smaller the delta, well, the more likely that it will wind up out of the money and we'll get to keep our credit. So basically, like this is kind of a throwaway or a given. So we'll move on. Quality versus quantity. So this is a Sharpe ratio versus the total trades. And we're looking for the lower right quadrant with the high Sharpe and fewer trades. So we got this dot that's kind of out here on its own. It's not really the lower right, but it is the right, and there's nothing really lower unless you go back to the left further. So we'll leave this one as it is. We got Calmar versus trades. So we got our Calmar ratio versus the trades. And Calmar or Mar ratio, same thing right here. We're looking at the lower right quadrant, high Calmar, few trades. So we got this one right here, I would say. Basically fits that one. There's one that's quite comparable, but we'll select this one because it's a little bit lower, and that's what we're looking for, lower right quadrant. All right. Coming over, we got Calmar versus win rate. Again, that win rate I would kind of throw away because the lower deltas is going to have a higher win rate percentage. But we're looking for the upper right quadrant, high Calmar, high win rate. And basically we've already selected that case study anyway, so we did that. Moving on, we got dual efficiency, which is the Calmar ratio versus the return on margin. And we're looking for the upper right quadrant, high Calmar, high capital efficiency, and maybe this one. And we'll select them. We'll see what this shows us. And moving on, we got pure performance. And this is comparing the CAGR versus the Sharpe ratio. And we're looking for the upper right quadrant, high CAGR, high Sharpe. And we got that selected. Actually, we have all three of them selected. So basically, we've selected all the best ones. We could customize it and we could, select different metrics that we want to compare. But I think we've done enough as it is. So let's scroll on down and take a look at what we got. All right, so here's our 5 back tests that we can look at on a chart. You can see our P&L comparison, and you can see that the blue one right there did the best. So the number one is generated the highest P&L, but that doesn't necessarily mean it's the best per se. So let's take a look at our results. And these back test results were making me warm, so I had to take off my jacket. All right, anyway, let me come back up here. I want to sort by, let's go ahead and sort by return on margin, highest to lowest. So we can take a look at our back tests. All right, so this is the number 1, which is what we talked about over here, the number 1. And let's go ahead and review it real quick. So in this particular back test, we were selling one put with a negative 35 delta, 40 days till expiration, buying a put with a $5 offset or negative $5 offset, 40 days till expiration. You can see that our capital requirements were very small, $3,789. So that's pretty nice. If you have a smaller account, that's something to be noteworthy. I would consider it noteworthy. We can see our total P&L was $17,993.50 for a full 10-year period. So, not the highest P&L, but also the capital requirements were quite low. Our return was 474%, so pretty good returns. Return on margin was 836.6%, so really good returns on margin. Our max drawdown was $8,203 or 60.9%, CAGR of 19.1%, Calmar of 0.31. And so, I think that this is a pretty good position to start trying to optimize, as it does have the highest return on margin. And it might have the highest return percent as well. Yeah, it has the highest return percent as well, and the highest CAGR as well. Now we can maybe get this Calmar ratio improved by having some different exit conditions or entry filters and so on. So maybe we can reduce our max drawdown or something to that effect. So we'll try and optimize this one. I'm going to go ahead and favorite this one because I want to try and optimize this particular position. And let's go ahead and move on to the next one. So this one, we had a delta of negative 35, so the same delta as our previous one. However, our offset was a $10 offset versus a $5 offset. So our capital requirements for this one was about twice as much, at about $7,946. We can see that our return was about 400%, or $31,728.50. Our return on margin was pretty good at 712%. We can see our CAGR was 17.4%. Our max drawdown was $13,296 or 37%. So quite a bit smaller max drawdown at 37% compared to nearly 61%. But the dollar amount's larger because we had more capital involved with this particular back test. But by having that smaller max drawdown, at least percent-wise, that really increased our Calmar ratio. We're at 0.47 compared to 0.31. But our CAGR was 17.4%. So, it's a fine trade. I want to look at the other back tests first before, favoriting this one. Let's move on and see what this one provided. So this was at a 30 delta and a $5 offset. So pretty similar. You can see kind of a trend. The higher delta with like a smaller offset seemed to do the best in these particular case studies. Our capital for this trade was $3,914, return of 400%. So, they're pretty similar to the previous one. Our return on margin was 692%. Our max drawdown was 36 8%, which is the lowest max drawdown percent that we have. So also dollar-wise, it was the lowest drawdown. CAGR is 17.5%, so better than this one right here. Calmar is 0.48, so better than this one right here. So I would say this is a better, back test or strategy than this one right there. But let's see if there's anything that stands out even more, because I want to just focus on one or two and really try and optimize those with like our exit conditions and so on. So this is the next one we have. We have a delta of 25 and a spread of $25. So this one's quite a bit different than the other ones we were just looking at. We can see that our capital requirements were also significantly more at $22,000. Our return was 220%. Our return on margin was 389.4%. Max drawdown was 23.5%, so our smallest max drawdown, at least percent-wise. However, dollar-wise, it was pretty big at $16,500, which is our biggest drawdown. Cash-wise, CAGR or 12.4%, Calmar ratio of 0.53, so our highest Calmar ratio. And so this one might be a good one to optimize, but let's check out the last one real quick. So this one, we are doing a 20 delta and a $25 offset, so pretty similar to the other one. We just have a 5 delta difference. Capital was about 22,000, so pretty much the same. Return was 195, which is, less than the other case study. Moving on down, our return on margin was 336 versus 389. Our win rate was higher, 92% versus 89%. Our max drawdown was also lower at 21% versus 23%. But our CAGR was lower as well, so we had a lower CAGR than our previous back test, and the Calmar ratios were the same, 0.53. So I'm going to go ahead and select this one right here as our favorite. So we have two favorites that we're going to compare, and they're pretty different. So we've got a 35 delta with a $5 offset, and then we also have a 25 delta with a $25 offset. So we'll go through and I'll run a few more back tests on these two particular strategies and see if we can optimize them. Maybe some different exit conditions or entry conditions will give us better results. So I'll be back with those results. Alrighty, so I went ahead and ran 24 more back tests, taking our two favorite back tests and changing different variables. So we changed the exit at days till expiration. We went 5, 10, 15, 20. And we also tried different take profits at 25, 50, 75, and 90, and also different stop losses as well. So stop loss at 25, 50, 75, and 90. So we did all those different combinations for our two favorite back tests. And I want to switch over to the scatter plot real quick because I think that gives us a great view of our results and makes it easy to compare them. All right, so let me go up to the top and let me unselect these real quick. All right, so the yellow ones are our favorite ones that we have already. So you can see our yellow ones right here, and we got some new ones, and they seem to be, maybe doing pretty good. They're at least out here with our other ones or beyond it. So we'll go through the different views and take a look at what we got. All right, so first things first, risk-adjusted returns, which is CAGR versus max drawdown. We're looking for lower right quadrant, high CAGR, low drawdown. So we got like 3. We'll go this one because that's the lowest, and then this one because it's the most rightest. All right, so we got those two right there, and let me select the yellow ones that we've ran previously as well, so we got those marked. All right, up next we have capital efficiency, which is return on margin versus max drawdown. We're looking for the lower right quadrant, and we got this one way out here. So that one, which is the delta of 35 and offset of $5, days to expiration of 40, take profit at 50%. So that one's way out there, and we'll dive more into it down here. But that one is way out there for capital efficiency. Consistency versus profitability, which is win rate versus total P&L. And in this instance, we're looking at the upper right quadrant, high win rate, high P&L. So we'll select this one right here just for another back test that we can compare. Moving on, we have quality versus quantity. And in this case, I'm not going to mark any. It's a Sharpe ratio versus the total trades. And you can see it's basically a straight line, and we actually have the highest one, lower right quadrant, which is like here, or here is the most right. But yeah, total number of trades is either 519 or 507. So we're not really comparing the number of trades. So that's why I'm gonna skip over that one. Calmar versus trade, same concept. We're going to skip over that one. Calmar versus win rate. We want the upper right quadrant, high Calmar, high win rate. So we got our pink one out here. So that one's still leading the way. Dual efficiency, which is Calmar versus return on margin. Upper right quadrant. So there's our pink one again. That one is like the top one in basically all scenarios. Peer performance is CAGR versus Sharpe ratio. So upper right quadrant, high CAGR, high Sharpe ratio. So upper right here, maybe right here. So we basically selected, the ones that gave us the highest ratings. So moving on down here, we'll take a look. Actually, let me go ahead and sort it. We'll sort it by CAGR highest. We'll go with that. All right, let's come on down here. We can see our our line graph right here that shows us our P&L. So we got like 3 or 4 that have pretty much the same P&L, and then we got 2 down here with a little bit lower P&L. But let's keep moving on. That's just P&L. And P&L can be a little deceiving because it's just like a total number. Capital to generate that P&L, so return or return on margin, seems more applicable to actually judging these particular back tests. So that's what I'm more focused on than the P&L itself, because, for example, this one, the capital was $3,706 versus like down here is $22,000. Now it generated more P&L. However, my capital requirements were like 1/6 as much. So I could basically do, 6 contracts for this, and my P&L would be 6 times higher when comparing a similar capital amount. So that's something to keep in the back of your mind when looking at this. It's not just the raw P&L number, it's the ratios and percents and things like that. All right, so right here, this is the highest CAGR that we got in 19.3, so that is pretty good and beats the historical market average of 10%. It's the 35 delta and a $5 offset. A take profit at 90%, so it's beating our favorite back test, which is right here, where we had no exit condition. So the one where we take profit at 90% has a higher CAGR than the one where we just hold until expiration. It's quite similar in terms of the CAGR. However, one thing that's not is our Calmar ratio right here, 53 to 31, and that's because our max drawdown was 36.7% versus nearly 61%. So this take profit of 90%, gave us some better results. We've already looked at this one. Let's continue on. So the next one with the highest CAGR was this one right here, which is a 35 delta and $5 spread. So again, with the 35 and $5, this one take profit at 50%, and we can see our CAGR is 18.8, so it's still quite up there, 5.5% difference right there. Our return on margin was still really good, 460%. Return on margin was significantly higher right here at 1,635%, and our max drawdown was only about 26%, so a smaller max drawdown, which has given us that Calmar of 0.73. So I really like this one because the capital requirements for it are so low. Like with having $5,000 available, we could basically run this trade, and our max drawdown was less than $5,000, 25.9%. Of course, we could scale it up. We could have more contracts and things like that, but that's the smallest max drawdown percent that we've seen so far, and the CAGR is still way up there at 18.8. So I like this one. We're going to go ahead and favorite that one, and that's the pink one that's been outlying on most of our results up here. So this one right here, this pink one, so you can see it's right here, and capital efficiency, it's way out here, the outlier right there. So that one's looking quite good right now. Moving on down, we have our first 25 delta and $25 offset right there. So that was the other original back test that we found that produced good results. And we can see that the CAGR is not as high. It's only at 12.4%. The max drawdown is the lowest we've seen so far at 23.5%. And actually, now that I'm looking at it, this is the one that we had originally, so without any exit conditions. So the one without exit conditions performed better than any of the ones that had exit conditions, and the only one that ranked well was the take profit at 75%. So I think I have my favorite now. I'm going to go ahead and uncheck this one, and we're going to keep this one with the 0.73 Calmar. We're going to go ahead and uncheck this one, and so there we go. So we have our our favorite one right now. So again, it is the -35 delta, 40 days till expiration with a $5 offset on our strike prices. And we take profit at the 50% mark. Let's go ahead and view results real quick and take a look at our results, our charts and everything. So we've seen most of this before. Our max losing streak is 5 in a row. So we lost 5 times in a row one time. And if we come on down here, we can see the comparison of buying and holding SPY. We have our VIX statistics, which we're going to mess with next. We'll mess with the VIX and the simple moving average as well and see if we can improve our results even more. So coming on down here, here's our equity curve right here and our capital utilization right here. So we can see our open positions, collateral tied up, available capital, and so on. So there's that chart. And then we can see all of our trades. So we see this first one expired. And the first time we did this, we lost the maximum amount. But then we started being able to close out and take a profit. We had a bunch of wins in a row. You know, a few losses sprinkled in here and there, but there's been, you know, significantly more wins. And of course, that's because the market usually goes up and to the right over, you know, the long period of time. Let's see if we can find our series of 5 red losses. And here we go. Here's when we had 5 consecutive losses over in May of 2022. So there's a series of losses, and you can see that we had some losses here and there, but for the most part, we were profitable in these trades. And also, while I'm thinking about it, one thing that's interesting is that we had a bunch of stop loss back tests as well, and none of those stop loss back tests did well for us. So having a stop loss seems maybe that it checked us out before we had enough time to actually turn a profit. And it was more profitable to just simply wait until expiration rather than, you know, stop our trade early. So that's just something that I found interesting. All right, so we have our favorite back test so far, and we're going to do a few more configuration settings just to see if we can squeeze a little bit more juice out of it. In this next segment, I'm going to be using these filters, so the VIX filter and the SMA filter. So I'll be back after running those back tests. Alrighty, so I ran like 17 more back tests, adjusting different filters, particularly the VIX filter. So I did low VIX. If the VIX was low, we ran several back tests with low VIX versus high VIX. And also some filters on the simple moving average. So the 50, 100, 200, and then price above, price below. And also did some roll management as well. So in this case, if the roll was triggered when loss hit 90%, so instead of doing like a stop loss, we rolled the position. The max days to extend was 45 days. Max delta change was 0.1. So right here, our delta is 35. So that means that I would roll to a 0.45 or 45 if needed. I was willing to increase my delta. And I wanted to roll for a credit, so I would not roll for a loss. I would roll in a limited number of times. And then I did want to maintain the width of the spread. So there was our $5 width right there. However, I was willing to increase it by $5, so I would increase it to $10. And that's just so there's enough room in order to actually roll for a credit. And I also synced the leg expirations because, of course, we wanted them to stay together so that way we kept our bull put spread. So anyway, having said all that, ran all the tests. And let's just go to the chart real quick and take a look. All right, so here is our gold position. So this is the one that we have been basing the other ones on. This is the best one we found so far. And we'll go through the same concept as before. We'll go through the different views and see if our gold one still outshines the other settings that we've adjusted. So we have the CAGR versus max drawdown, lower right quadrant. And so we got our gold one out here. It's definitely the furthest. This one's a little lower, but we'll go ahead and let the gold one lead the way. So we'll go ahead and select that one. Capital efficiency, so that's return on margin versus max drawdown. We got this one way out here. What is this one? And this one has the low VIX between 1 to 10. So I'm just going to select it just to see what shows up. I bet we have like 1 or 2 trades or something like that. And so that probably generated a high return on margin compared to our max drawdown. Consistency versus profitability, so that's win percent compared to total P&L. And we got that one outlier right here. Here's our gold one. Let's move on. We have our quality versus quantity, so Sharpe ratio versus total trades. Look for lower right quadrant, so nothing really over there. We got our gold one still out here, so that one's staying out. Calmar versus trades, which is lower right quadrant, high Calmar, fewer trades. And we've got this one right here that's kind of standing out from our gold one. We got one a little bit past that, so we'll select that one. Calmar versus win rate. Upper right quadrant, high Calmar, high win rate. So we got our gold one, we got our now purple one right there. Let's move on to dual efficiency, which is Calmar ratio versus return on margin. And we got our gold one and our purple one right there. Okay, and we got peer performance, which is CAGR versus Sharpe ratio. And we're looking at the upper right quadrant, which is our gold one again. So anyway, there's our positions. Let's just take a quick look. We got our gold one on the top in regard to total P&L, and then we got our purple one. So let's scroll on down. And so here's the one that we've been running with. This is our favorite one. And just quick reminder of the settings. So -35 delta on the short put with a 40 days till expiration, and a $5 offset on the long put with 40 days till expiration. Take profit at 50%. And we can see our Calmar ratio of 0.73 versus the Calmar ratio up here of 0.78. So this one has a higher Calmar ratio, and the setup is basically the same except for our roll management. So here we were rolling on the 90% loss. We had 118 rolls on 118 different trades, and so those are kind of the results. So we had a higher Calmar ratio, which means basically that our max drawdown was less with rolling than it was over here without rolling. However, you can see that our return when we weren't rolling was higher, 460% compared to 365%. Our win rate was better when we weren't rolling, so a lot of the rolls wound up not being profitable, it seems like, as we had a win rate of 78.2 right here. And also looking at CAGR, our CAGR was only 16.6% versus 18.8% when we weren't rolling. So we had, a little bit less drawdown, basically. However, our return was less, and it doesn't seem like taking on the risk of rolling is actually really worth it, because it also lowered our CAGR compared to when we weren't rolling. So I think our favorite one is still standing strong. And here's that one outlier that had the very low VIX. So you can see we only had 13 trades right here, and our max drawdown was only 18.5%. So really small max drawdown. Our CAGR was 4.6%, return was 56.5%. Our Calmar ratio is 0.25. And so obviously the times that the VIX are that low is very, very minimal. It was 13 trades in a 10-year period. So it was just an outlier, kind of stood out, but I don't think that's like a real actual investing strategy. And so to go ahead and conclude, I would say that this is the best settings for a SPY credit put spread or put credit spread. Again, it is the short put on a 35 delta with 40 days till expiration, and buy a long put with a $5 offset, 40 days till expiration. Take profit at 50%. And as a reminder, we were doing this trade every Monday, and if the market was closed that Monday, well, then we just put the trade on the next day, and this gave us the best results. And I really like this trade because it does not take a lot of capital. There's $3,651 of capital. So if you have $5,000 in your account, you could put this trade on, and just so long as you don't, hit a bunch of losses right out the gate, like, you should have enough money to continue on even through a max drawdown period. And so I think I'm going to start putting this trade on. I've been doing an iron condor trade every Monday. However, this has better return, better CAGR, better Calmar ratio than those iron condor trades that I'm putting on. So I'm thinking I'm going to start doing this trade instead of iron condor. So that's just the research that I've done and the analysis that I found. Hope you found this video interesting. If you're interested in checking out our tool here, it's just at optionsforall.com or tool.optionsforall.com, or link in the description down below. Hope you found this video interesting or helpful. If you liked it, I appreciate your sorts of likes, comments, subscribes, and I hope that you have a great rest of the day.